Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about a company which just 6 months ago was my best performing stock but has since dropped to one of my worst. If you've been keeping up with the channel, you might have been able to figure out that the company I am referring to is Tesla, ticker symbol TSLA. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. Best known for their sleek electric vehicles, they dabble in other notable products including battery storage devices, solar panels, and solar shingles. In 2023, Tesla sold 1.8 million vehicles compared to the 1.3 million vehicles that they sold in 2022. That represents a massive year-over-year increase of 38%, but regardless, Tesla's had an awful start to the year, down over 30%. So as you can see right here, Tesla is actually my 5th worst performing stock right now out of my 24 different holdings, up only 9%. Now I will say I'd rather have it up 9% than down 9%, but just a couple months ago I was up over 80% on this holding, so it's been a pretty rough ride. So filtering out my holdings by Tesla, we can look at some of its stats right here. I did pay an average price of $156.61 per share, which was a very good price to me at the time. Now, since I did purchase it at such a relatively low valuation, we can see that the current price is still higher than what I bought it for, sitting at $170. Had I had more capital invested as it continued to go down, I could have gotten shares at a very low price, close to $100 per share, but after 2 shares, I actually stopped right there. In total, I invested $313 in Tesla, and my current value is sitting at $341. That gives me a net gain of $28 or a percent change of 9%. As expected, I have no dividend stats with this company since they don't yet pay a dividend, but my allocation out of my total portfolio is right under 1%, so it is a very small holding of mine. Now, taking a quick look at my order history, this is where I keep track of every single purchase I've ever made from my portfolio. This helps me both stay organized and it helps populate the rest of the sheets within my portfolio tracker spreadsheet. So as you can see here, I did buy my shares on December 15th, 2022, and I bought a total of 2 shares at the same time for $156 per share. Now after I purchased it, the price did continue to drop all the way down to almost $100 per share, but I held on to my 2 shares and decided it was enough for me at the time. And as we'll see in their historical performance, after purchasing these shares, I actually saw very nice price appreciation for the next couple of months. Like I said, up almost 80% on my position, but since then it has declined pretty drastically. Taking a look at my pie spreadsheet, this is my favorite sheet within my Google spreadsheet, and it helps show all my breakdowns for different stocks and positions. As you can see right now, my portfolio balance is sitting at $37,000 and my cash position is sitting at $1,500, which is fine, and I'll keep growing the cash position for now as long as I can. What I mainly use the spreadsheet for is to break down my allocations of how much I want to invest into different sectors. My key to success is my ETFs, which we'll take a look at in a second. My divine dividends are my dividend stocks that I consider to be very safe relatively, and my speculative section is stuff that either doesn't pay a dividend or is a little bit more risky. My target allocations are 50%, 40%, and 10% for each, and as you can see, I'm actually very close on those target allocations with my actual distributions. Our main focus today will be the speculative section of my portfolio, and we'll take a look at that by clicking my slices button, which will open them all up, and we can see the different allocations. So real quick, in my largest pie, you can see I have VOO and SCHD. This is my ETF section, and it's the foundation of my portfolio. Looking at the Divine Dividend section, we can see it has much more holdings than my second largest allocation at 40%. I have different companies here, including Coca-Cola, Texas Instruments, Apple, Microsoft, and Visa. And if you're wondering, whatever's highlighted in red is actually on the chopping block I might get rid of soon. And in yellow, I might be choosing one or the other to keep instead of having both. And most importantly for this video, we have our speculative section. Right here, we have companies like Ford, Google, Amazon, Tesla, PayPal, Target, 3M, and Intel Corporation. These are just companies that I wouldn't consider as safe, or in some cases, like Google, I think it's a great company. It just doesn't pay a dividend, so I like to throw it into here instead of grouping it with the rest of my dividend portfolio stocks. So right here, we have a nice breakdown of Tesla. We can see that I hold a value of $341 with the Tesla. My target allocation for this is actually 20% within here, and at some point, it was pretty close to that. But right now, as the price has dipped, it's sitting at 8.2% of this specific pie. As I mentioned before, that's only 0.9% of my total portfolio, so I'm not concerned with that. It won't have a large effect on my investments, but I definitely wouldn't mind growing this position more if the price continues to dip at some point. So as we can see right here, Tesla has been by far the worst performing stock with the S&P 500, and it's definitely not something that I expected going into this year. Some of the other companies giving it a run for its money are Boeing, Warner Brothers Discovery, and Charter Communications, which some of these are very expected. The thing that I'm most surprised about actually is that even with all the failures Boeing has had recently, it still hasn't performed as worse year to date as Tesla has. And I thought it would be fun to just look at the best performing stocks within the S&P 500, and as we can see at number 1 is Super Microcomputers. I do believe it recently got added into the S&P 500, and it's up a whopping 242%, which is just insane. Just to put that into perspective, over the past 10 years, the S&P 500 is only up 182%, and in the past 3 months, Super Microcomputers has grown significantly faster than that. And almost just as impressive, we have Nvidia Corporation that's up a little over 90% year to date, and it's been on a crazy tear this past couple months. So aside from the rough performance it's had year to date, this past 1 year has not been nice to Tesla either, still down over 10%. However, this company has had a history for being a growth machine, and if we look at the 5 and 10 year time frame, we can see that that is very much true. In the past 10 years, Tesla is up 868%, and in the past 10 years, it is up a massive 1,120%. So anybody who's been holding it for longer than 4 or 5 years is sitting very nicely regardless of the recent price drops. If we look at the company's performance since IPO, we can see that it's up 13,000%, and a lot of that growth did happen from 2018 to 2021. Right now, it is sitting near its 52-week low, which was $152 per share, and if it dips down that low, I will actually be in the red myself. So a big part that Tesla has experienced such a decline this year is it just seems like there's been one problem after another with this company. I'm sure if you guys have been paying attention to news surrounding Tesla, it seems like there's been one negative headline after another and then dozens of those per week. Some of the more recent ones that are very notable to me include the fire at Tesla's Gigafactory in Berlin. Because of the fire that was allegedly started by the extremist group, Tesla had to actually shut down operations for a week at their Gigafactory. Of course, this headline in itself is not the worst news possible for Tesla, but it was just piling on to other stuff going on at the time. More recently, Elon Musk defended his use of ketamine, which he says is a prescription drug that he uses to relieve a negative chemical mind state that he gets. He argued this is overall a benefit for the Tesla maker, but this is not the first time that Elon has come under heat for his drug use. Another piece of news that has not helped the company is that Hertz is selling off a lot of their Tesla fleet. In 2021, Hertz announced a plan to purchase 100,000 Tesla vehicles, but right now in 2024, they're actually looking to sell about 20,000 of their electric vehicles, a lot of which are Teslas. At the moment, it seems that they've already listed 607 ex-rental Teslas, but I'm sure they'll be increasing this number over the next couple months. Although this might not be the biggest deal at Tesla, it does show the EV market may show signs of weakening and that companies and consumers are moving back towards internal combustion engines or even hybrid vehicles. A bigger piece of info that has shaken up the market is Tesla's performance in China. The company has experienced weaker than expected sales figures from China, and their profit margins have dipped all the way down to 17.6%. Now, if you guys are familiar with Tesla investors, you know that they're never happy when they see that margins dip. The auto industry is already a relatively low margin industry, so every time it dips lower, it's a pretty big hit to the financials and the earnings of the company. It seems that in China, Elon Musk has had a very hard time competing with the Chinese car companies because they're able to offer better prices for their consumers. Although sales in China did grow 6.8% in the first 2 months of 2024, investors took that as a negative because they were expecting higher growth rates within this industry. And now, of course, Tesla has recently released its long-awaited Cybertruck, and of course, it's had plenty of problems since then. This is just one example of an article bashing the new Cybertruck, but there have been countless others that have talked about issues with its reliability, its design choices, and also the quality of its manufacturing. And now, as if that wasn't enough, Elizabeth Warren has now called on the SEC once again to investigate both Tesla and Elon Musk. This is not her first time making this request to the SEC, but this just adds to the list of stuff that has been beating down the stock over and over again. Jumping into Seeking Alpha and looking at their financials, we can see first of all the revenue has been increasing nicely over time, currently sitting at $96 billion. This is a very good indicator that the company is growing quickly, but of course revenue does not show the full story, and what we want to look at also is earnings per share and free cash flow per share. Especially since this is such a low margin industry, high revenue is not necessarily indicative of better financial performance. One thing to note real quick is that their R&D expenses have been increasing pretty quickly over time, and this of course is going to eat into their free cash flow per share. Looking at their earnings per share, we can see that it's performed similarly to the revenue per share, but not quite the same. It was actually negative in 2019, very flat for 2020, but then in 2021, 2022, and 2023, they have continued to increase it very quickly. If Tesla is able to continue growing their earnings per share over time, this will be a very good success story for this company. And one thing that I personally don't like to see is that their outstanding shares have increased over time. Now, it's not increasing at an incredibly fast rate, but still faster than what I would like to see within the company. Now, since this company is still relatively a younger company and is doing a lot of expanding, especially within its factories, both the Gigafactory in Berlin and the one in Austin, I can still see why this might happen, and I give them a little bit of slack with that. In the long term, selling shares in order to raise capital for capital expenditures such as gigafactories can be better for the shareholders, especially with the high interest rates we have seen recently. So as you would expect with a company like Tesla, their stock-based compensation has been relatively high, but it actually hasn't been increasing every single year. We can see in 2021 is actually when it last peaked, and in 2023 it's still lower than that, which is nice to see. Over time, I do hope their stock-based compensation remains under control, because otherwise it can become a situation like Amazon where the stock-based compensation is much higher than what I would like from a company like them. And now for Tesla, capex or capital expenditures has been a huge sink for where their money has gone. Looking at this graph, we can see that in 2019, they had spent $1.4 billion in capital expenditures. And fast forward to now, we can see that in 2023, they did spend $8.9 billion on capex expenses. Now, at the end of the day, capex is technically investment back into the business, so you could make the argument that over time, this will be beneficial to the shareholders and the investors of this company. Regardless, I am looking forward to seeing if this number will go down over time since they're establishing more and more of their gigafactories and potentially would not need to be investing as much back into the company anymore. At their current rate, this has been increasing very quickly and it looks almost in line with their revenue increases. And the last metric I want to take a look at here with Tesla is their free cash flow per share. It's actually not as bad as what I anticipated when I was first looking into this company. You can see that overall it has been increasing nicely over time. Unfortunately, 2023 was a pretty big dip, but that could also be argued that it's because of all the money that went towards the capital expenditures. The one thing I will say is that compared to their earnings per share, this is relatively a low number that they're able to save in free cash flow per share at the end of the year. Moving into their growth metrics, we can see that it has been pretty solid at 18.8% year over year, and looking forward, they're expecting a 17% growth in their revenue. Now, this financial performance is a very good sign, but we do have to keep in mind is that Tesla does command a very high valuation in the market. So potentially, investors might begin to expect a high revenue growth than the company is able to deliver in order to keep that valuation the same. The part that I struggle the most with this company is their profit margins. I talked about it a little bit earlier, but the automotive industry is not known for its great margins, and that's a big problem Tesla faces as well. I would say this company runs pretty efficiently for an automaker, but at 18.25%, that margin is still very low, and investors definitely would love to see it higher. The problem is there's not much more to do in terms of making it more efficient. Tesla just functions within an industry that has a very high level of capital expenditures needed in order to keep it going, and I'm just not sure that it's going to get any better for it in the near future. Now, comparing that with a company like Apple, of course, we can see that their gross profit margins are sitting at right around 45%, which is significantly better. Now, obviously, I do know that's not a fair comparison, but I just want to make you guys aware of that situation and how different companies have different profit margins and how it helps drive their business. So as is to be expected, year to date, Tesla is lagging the S&P 500 by a pretty large margin, down 31% compared to the S&P 500, which is up almost 10%. Looking at their one-year performance, it's a very similar story. The S&P 500 is up a whopping 33%, whereas Tesla is down 10% in the past 1 year. However, we can't see how ridiculous Tesla's growth has been in the past 5 years by putting on that graph versus the S&P 500. It basically puts the market to shame, up 868%, whereas the market's only up about 87% these past 5 years, which of course is still good. Looking at their price to earnings ratio for the past 3 years, we can see that it's currently sitting at around a 40 PE ratio. Compare that to its historical average, it's actually sitting pretty low, and if you look at the 3-year mark, it has decreased a lot since they started getting more profitable. Now, just because a company is sitting near their 52-week low does not necessarily mean a company is undervalued, and the same thing can be said for a company that's at its 52-week high. It doesn't always indicate that it's overvalued. You always have to make sure you're doing your due diligence before investing in any company. And the last thing I want to take a look at here for the past 5 years is their total common shares outstanding. We can see that it's been increasing over time, which, like I said, is not something I want to see, but it's to be expected with the amount of investments that they've been doing back into the business. I think at some point Tesla will start buying back their shares aggressively. I just don't think we're there just yet. And the last thing I want to take a look at before we end this video is Tesla's all-time performance versus the S&P 500. So 2011 is a little bit after they went public. I think they went public in June of 2010. And we'll use the S&P 500 as a benchmark for our calculations, and we'll make a portfolio with Tesla at 100% of its allocation. Now, if we do analyze the portfolio, we can see that if you would have invested $10,000 back near IPO, you would have been sitting at a final balance of $1,137,000, which is crazy. Compare that with the S&P 500, and you would have been only sitting at $51,000 had you invested that $10,000 into the S&P 500 in 2011. Looking at the portfolio growth graph, we can see that if you would have invested in either or $10,000 within the first 3 years, you would have actually been sitting at around the same value for both the S&P 500 and Tesla. However, in 2013, your $10,000 invested in Tesla would have become $72,000, and if we fast forward to 2022, you would have actually been sitting at a high of your portfolio at $2 million. Of course, with the recent stock decline we have seen in Tesla, your current value would be sitting at $1,100,000. Looking at the annual returns for Tesla, we can see that in 2013, they had a massive year. They were up 344% that year alone. And their best year by far was 2020, up 734%. It just goes to show you that only a couple years can make a really big difference in your investments. As always, that does bring us to the end of today's video. I really hope you all enjoyed this spotlight video on Tesla and saw some insights as to why I purchased it when I did and what's happened so far to my investment in it. If you did find this video useful, definitely leave a like, and if you haven't subscribed yet to the channel, please do so. It helps me out a ton. Also, let me know down below whether you've been buying Tesla at these recent lows or if you're waiting for it to drop any further. or if you're just staying completely away from this stock in general. If you guys do want to check out my most recent video where I go over 3 dividend growth stocks that you can buy once and hold forever, check it out right here. And if you still haven't watched my stock spotlight on Broadcom, definitely check out this video right here. Other than that, I hope you all have a great rest of your day, and I will see you in the next one.